Okay, let's unpack this. We have a source stack today that is not exactly concerned with the utopian vision of artificial intelligence. It's a critical, almost surgical look at the impending financial reality.
Right.
Today, we are undertaking a deep dive into what the source material starkly labels the AI exit liquidity trap.
And that harsh tone is absolutely intentional. I mean, it's necessary to adopt it immediately.
Why is that?
Because the tsunami of information you're about to encounter over the next, say, 18 to 24 months, from financial news, from glossy magazines, from every social media feed, it's all designed specifically to create one emotional state in you.
FOMO.
Desperate FOMO, the feeling that you must buy in immediately, that this is your only chance.
And that is the core conflict we are dissecting here. Our mission is to, cut through that noise, to strip away the utopian hype, and look directly at the financial engineering underneath. We're focusing on this massive wave of artificial intelligence initial public offerings, or IPOs, that the sources are pointing to for 2026. And we're going to explain why, for the average person, these are not genuine investment opportunities.
No, they're a final, massive wealth transfer.
Away from the public?
And toward the early insiders. It's not about democratization of investment. Don't let them tell you that. This is a transaction, plain and simple, built on deception and perfect timing.
The source material opens with a line that, frankly, should be laminated and stuck above every investor screen. It's brutal, but it captures the cyclical nature of this market perfectly.
I know the one you mean.
There is a game played on Wall Street every 10 years. It's called Pass the Bag.
And we have to establish this pattern first, because the AI trap is simply a new iteration, a new flavor of a very old, very cynical playbook. If you don't recognize the pattern, you're guaranteed to become part of this negative outcome.
It's like a recurring economic ritual.
Exactly. The bag changes. It's always dressed up in the latest, most exciting tech or financial instrument. But the mechanics of extraction, of taking your money, they remain identical.
So let's ground ourselves in history, just to see this clearly. In the late 90s, early 2000s, the bag was filled with .com stocks.
Oh yeah, Pets.com, Webvan.
Exactly. Companies with literally zero path to profitability, but, infinite hype based on this vague idea of internet growth. Valuations were based purely on clicks and eyeballs.
A completely meaningless metric, but the insiders, the founders, the early VCs, they sold those inflated shares to the public just before the calendar turned to 2000.
They cashed out billions.
Billions. And when the bubble burst in 2001, the public, the average investor who bought the story at the top, was left holding the bag, holding shares that just evaporated.
Then, fast forward to the run-up to 2008. The bag was repackaged. It wasn't digital at all this time.
No, it was structured debt, specifically mortgage bonds. These incredibly complex, opaque financial products that the banks themselves created and then, slapped a AAA rating on, knowing they were full of toxic subprime mortgages.
The smart money, the sophisticated traders, they saw the risk.
They saw it around 2007, and they started shedding these assets, selling them to less sophisticated buyers, pension funds, municipal funds, foreign banks, who just trusted the ratings.
So once again, the insiders got out.
Made generational fortunes, and the average person, through their pensions and the global financial crisis, suffered the consequences.
And then most recently, in that white-hot liquidity flood of 2021.
Oh, the SPACs.
The SPAC tax. Special purpose acquisition companies. These were basically vehicles designed to take high-risk, unprofitable private companies public with far less regulatory scrutiny than a traditional IPO.
That was the fastest version of the game we've ever seen. I mean, money was basically free, and the hunger for high-growth tech was just insatiable.
And we saw companies like Nikola promising futuristic trucks that didn't work.
WeWork, promising to revolutionize office space.
Yeah.
They all flooded the market at these just insane valuations.
And the VCs sold at the absolute peak.
At the top of the frenzy. And within 2 years, many of those stocks were trading 90%, 95% below their offering price. The public was, once again, the exit liquidity.
So that brings us to today. The source material is unequivocal. In 2026, the target is the AI IPO wave. And this gets us to the core question, the single most important piece of critical thinking we can offer you.
Right.
If these AI companies are truly the money-printing machines of the future, if they are destined to create generational wealth, Why are the founders and the venture capitalists, the people who actually built them, so desperate to give you their shares?
It sounds so simple when you say it like that, but it's a point that gets completely obscured by the hype. I mean, think about the most valuable thing you own. If you knew for a fact it was going to 10x in value over the next 5 years, would you sell it right now to a stranger?
Absolutely not. You'd hold on for
Wow.
dear life.
Of course not. So the fact that the insiders are selling and structuring these incredibly complex financial exits tells you they know two things. One, the current valuation is inflated way beyond reality.
Too.
Two, the hypergrowth phase that justified that absurd valuation is definitively over. They know the best days are behind them.
They need to cash out. They need to complete their multi-billion-dollar exit, and that introduces this unfortunate but necessary term, the bag holder.
We have to define this role because it is the role the public is being groomed to play. The bag holder is a brutal term, but it's a necessary one. It is the last person who buys the asset, the last link in the chain, just before the price collapses.
And they are left holding the bag.
A bag filled with highly depreciated, often worthless stock that everyone else sold off. The VCs structured this entire process to ensure that the last buyer, the person who provides the liquidity for their yachts and private jets, is the public investor. That someone, they hope, is you.
Which leads us directly to the core mechanism, the concept of exit liquidity. This phrase explains the entire purpose of the IPO in this context.
Exit liquidity, yeah. It fundamentally defines the public offering, not as a partnership, not as an invitation, but as a mechanism for transfer. When a private company goes public, the VCs aren't standing on the balcony saying, "Welcome, new partners."
What are they doing?
They are ensuring there is sufficient market depth, meaning enough new capital, enough demand from millions of buyers to absorb the massive volume of shares that they plan to sell. They need you to buy so they can sell without crashing the price on their way out.
So the confetti and champagne on IPO day, it's not a celebration of the company's future.
No, it's a celebration of the VC's successful escape. It's just a necessary market function for the smart money to lock in their returns.
It's the handoff.
It's the perfect handoff, and the sources capture this perfectly with a hot potato analogy. The VC is not handing you a baton to continue the race. They are handing you a stick of financial dynamite with a short, predictable fuse.
And the media is playing along.
The whole ecosystem is. The media is hyping the tech. The bankers are structuring the sale. But the insiders, they know that stick is about to explode in the hands of whoever's holding it 6 months after the listing.
They are trying to trick you into buying their garbage.
Because they know the clock is ticking on the technology and the market structure itself.
That sets the stage beautifully for why the VCs are so motivated to sell. But now we have to dig into the fundamental breakdown that triggered this urgency, the technological barrier that makes the current AI valuations a complete fantasy.
Right.
This brings us to part one, the technology deception, which centers entirely on the concept of the scaling wall.
The entire multi-trillion-dollar market cap of AI, both private and public, was built on the promise of one single thing, the scaling law. For almost a decade, this wasn't just a trend. It was like a law of physics for this technology.
And what was that premise? Describe the magic that drove these valuations from a few million to tens of billions of dollars.
For years, it was simple, almost too good to be true. You had an existing large language model, let's say GPT-3, and if you added 10 times more high-quality data and 10 times more computational power, compute, you would reliably get a 10 times leap in the model's intelligence, its coherence, its capability. It was this perfect exponential curve.
So more money in, more intelligence out, a predictable machine.
A predictable machine. And that perfect correlation between input resources and output intelligence is the only way you can possibly justify valuing a company with no profits at $50 billion. The expectation was clear. AGI, artificial general intelligence, was just a few more data centers away.
But the sources indicate that the VCs who are now rushing for the exit, they're not just being opportunistic. They're reacting to quiet, leaked internal reports from the big labs, OpenAI, Google, Anthropic.
Exactly.
What are these reports privately confirming that the public narrative is desperately trying to suppress?
They confirmed that the exponential curve, the one that guaranteed future performance for a simple input of cash and chips, has hit a wall. A massive, insurmountable wall, at least for the current way they build these things. That predictable scaling has stopped. It's over.
It's become a law of diminishing returns.
A law of diminishing returns on a grand, terrifying scale.
So walk us through that failure point. What does this actually mean for the next generation of models, like the rumored GPT-5 or whatever Google's building next?
It means the cost-to-benefit ratio has completely shattered the business case. To train the next model after GPT-4, labs are spending not hundreds of millions, but literally billions of dollars. This money goes into thousands of specialized chips from NVIDIA, building vast new cooling facilities, consuming energy on the scale of a small country.
And the outcome of this astronomical investment is...
Not the 10x leap everyone expected. The sources suggest the yield is closer to a 10%, maybe a 15% improvement in capability.
So an exponential input of capital now yields only a linear, maybe even logarithmic output improvement. That completely breaks the entire investment thesis, doesn't it?
It annihilates it. It completely destroys the justification for these multi-billion-dollar valuations. If you are priced for AGI next year, but the reality is that the next version only gets you a tiny performance boost at 1,000 times the energy cost.
Yeah.
The whole valuation structure just collapses.
And why has this happened? Why can't they just keep feeding the machine more data, more compute?
It's primarily data exhaustion. LLMs thrive on clean, high-quality, authoritative human data. Think Wikipedia, all the books ever digitized, scholarly articles, meticulously edited journalism.
The good stuff.
The good stuff, we've used it all up. The internet is fast, yes, but the rest of it, the unprocessed data, is overwhelmingly low quality, repetitive, or, and this is the critical part, has already been synthesized by AI itself.
So you get AI training on AI content.
And you create a feedback loop of statistical mediocrity. It's called model collapse. Garbage in, garbage out. The low-hanging fruit has been picked, and the cost of finding and curating genuinely unique, high-quality human data is now becoming exponentially prohibitive.
And this is where the deception takes root. The technological reality is stagnation, or at least a sharp deceleration. But the financial valuation, the price tag they slap on the IPO, has to pretend this reality doesn't exist.
Exactly. The valuation is the lie. These companies are priced for AGI tomorrow. The VCs need the public to maintain the feverish belief that the big breakthrough is imminent, that the world is about to change in 18 months.
But the people reading the internal reports, the VCs, the high-level engineers, they know AGI might be a decade away.
If it's even achievable with this technology at all. And that knowledge creates a catastrophic gap, this chasm between the expectation, this vertical exponential growth chart, and the reality, a sudden costly plateau. That is the foundation of the bubble.
And the smart money is not waiting around.
They are not waiting for the public to figure this out. The IPO rush is timed to happen precisely in that window, where the technological failure is known internally, but hasn't yet shown up in a disastrous public quarterly earnings report.
It's a visual deception. The vertical line on the graph has suddenly flattened out, but the only thing the public is allowed to see is a massive billboard covering that plateau.
And that billboard, with BUY now plastered all over it, is the marketing engine of the IPO. It is the deliberate concealment of technical reality. The moment the market realizes that progress is logarithmic, not exponential, these valuations become instantly, catastrophically unsustainable. They are selling you a future that they know has been pushed out by a decade and costs 10 times as much to achieve.
So the scaling wall is this deep, fundamental technical failure. But even if a miracle happened and the scaling resumed, most of the companies rushing to market are facing an even more immediate mortal threat to their business. We shift focus now from the engine to the vehicle itself. This is part 2, the business model trap and the unavoidable wrapper wipeout.
Right. When we look at the hundreds of these AI startups that VCs are rushing to offload, what the sources aptly call the zombie unicorns, we need to understand their inherent fragility. They raised all this capital during the frenzy, but their business model is built on sand.
And what is the defining fail characteristic of, say, 95% of these companies that the public will soon be asked to buy? It's what the sources call the wrapper crisis.
The term is perfect. These companies are not foundational developers. They're not OpenAI or Google. They didn't spend billions training the core LLMs. They are essentially thin user interfaces built on top of rented brains.
Rented brains.
They're licensing access to ChatGPT or Gemini or Claude through an API. They add a light layer of specialization, a nice-looking dashboard, and they charge a premium for it. They run the cognitive engine, but they don't own the car.
So give us a specific sense of what these wrappers look like in the real world, the ones that raised billions.
Oh, they're everywhere. Think of a startup that offers AI-driven personalized marketing copy, or an AI tool for reviewing medical billing codes, or a legal AI assistant that summarizes complex court filings.
So they all seem useful on the surface.
They are, but they're all using a foundational model like GPT-4 under the hood. They integrate it into a specialized workflow and charge, I don't know, $50 to $100 per user per month. Their entire business, their entire competitive advantage rests on one fragile hope,
Which is?
that the foundational model provider or a platform giant never decides to do that same thing themselves for free.
And that hope has a name in the industry for when it goes wrong. It's called Sherlocking.
Yes.
Explain the terrifying threat of the platform giants entering this space.
Sherlocking, as we know, is when Apple, Google, or Microsoft sees a thriving third-party app and then just integrates that functionality directly into their core operating system or
Yeah.
their suite of products
And now they're applying that to AI.
at a terrifying scale. This is the existential event for these wrappers. Apple just announced Apple Intelligence, integrated deeply into iOS for free. Microsoft has integrated Copilot into its ubiquitous Office suite and Windows 11.
So let me get this straight. If I'm a rapper startup and I'm charging $50 a month for my cool AI writing tool, and then Microsoft just integrates that exact function, maybe even a better one, into the Office 365 subscription I already pay for.
Your revenue goes to zero overnight. Your entire business is now a feature. You've lost your moat, the sustainable competitive advantage that protects your revenue stream.
And the giants can do this easily.
Easily. They have infinite scale, infinite distribution channels, and their cost structure is completely different. They can afford to give your product away as a free feature because their core revenue comes from hardware sales, cloud hosting, search advertising. For the wrapper company, the cost of the API calls to OpenAI is a primary expense. For Google, it's just marginal computation.
So these zombie unicorns, they're not building sandcastles on the beach. They're building sandcastles in the direct path of an oncoming tsunami.
That is the perfect analogy. And the visual is this massive tidal wave labeled Apple Google, just washing over the tiny little sandcastle labeled AI startup. The VCs who own 40% of these wrapper companies, they know this tsunami is coming. They are not waiting to see if their sandcastle survives.
They're rushing to offload these doomed assets onto the public market before the platform giants execute the Sherlocking maneuver.
Before the wipeout.
So is there any scenario where a specialized wrapper company does survive? Are we being too harsh on some of these that are solving niche problems?
That's a fair question, and the answer, according to the sources, is yes, but it's very, very rare. They have to achieve two things. First, they must operate in a niche so regulated or so technical that the platform giants won't touch it. Think like proprietary engineering simulations for aerospace.
Okay, and the second?
And this is the most critical part. They must develop their own proprietary dataset that the LLM giants do not possess. If their value is based solely on a clever prompt and a dashboard, they are dead men walking.
And the VCs know their portfolios are filled with these.
Filled with the latter, which is why the IPO clock is ticking so loudly.
The analogy they use in the source material perfectly captures this.
They are selling you a franchise to operate a blockbuster video store in the year 2010. They are selling you dial-up modems right as fiber optics are being laid in your street. The technology that defines their entire business is already being commoditized by the market leaders, and the VCs are trying to trick the public into buying the last of the inventory before it's completely worthless. Okay. So we have the motivation, the technological wall, and the business model weakness driving the VCs to sell. Now let's turn to the mechanism they use to extract the wealth. The financial engineering that makes the public the necessary victim. This is part 3. The financial mechanics of the exit, or the IPO trap.
I think we need to challenge the very premise of the name, IPO, initial public offering. It sounds so inviting, like the start of a great journey.
It's the ultimate linguistic trick in finance, isn't it? The name implies commencement, growth, opportunity. But in reality, for 90% of these highly hyped tech listings, it is the end. It's the end of the easy money. It's the moment the private investors complete their extraction cycle.
Because the company has already reached its peak valuation in the private market?
Before you even get a chance to buy in.
Let's lay out the math of this extraction clearly, because it shows the impossible burden that's placed on the retail buyer.
The game is fundamentally rigged by the time you're invited to play. The VCs and the early founders, they invested during the seed and Series A rounds maybe 5-8 years ago. Their entry valuation might have been, say, $10 million or $50 million.
Pennies on the dollar compared to the IPO price.
Exactly. They spent the next 8 years using hype, media, and private funding rounds to inflate the company's perceived value. By the time they IPO, the valuation they set for you, the public, is $10 billion.
So the VCs have already engineered a 100x, maybe even a 1000x return on their initial investment just by holding the stock privately and hyping the future.
They are selling you the absolute top of the curve. Now, consider the retail buyer, the public investor who reads the glossy prospectus on IPO day and buys those shares at the $10 billion valuation.
Right.
For that public investor to see a 10x return, to see the kind of wealth generation the VCs just experienced, the company has to grow from $10 billion to $100 billion.
That second leg of growth is exponentially harder.
Infinitely harder, slower, and far more uncertain. It is a mathematical trap from day one. It's the difference between climbing the first mile of a mountain when nobody is watching and trying to climb the next 10 miles under the glare of global scrutiny, carrying the weight of that initial $10 billion price tag.
And historical data confirms that betting on the public phase of these hype cycles is just a losing game.
It's a sucker's bet. Look back at the recent past. You mentioned Peloton. IPO'd at peak pandemic fervor, priced for eternal home fitness dominance. WeWork, promising to revolutionize how people work. Rivian, valued higher than Ford before they'd even built cars at scale.
And the common thread in all those hot tech IPOs.
They IPO'd at the peak of market liquidity and the absolute peak of the hype cycle.
Yeah.
The public bought the narrative that this was the next Amazon or the next Google, and every single one of them, Peloton, WeWork, Rivian, crashed 90% or more within 18 months of their offering.
The retail investor bought the story.
But the VCs and insiders were the ones selling the shares into that euphoria. The easy money had already been made long before you got there.
This highlights the structure of the wealth transfer. The sources call it the pyramid structure.
Visually, it's the clearest way to understand the dynamic. At the very top of the pyramid, you have the founders, the VCs, and the investment bankers who organize the sale. They get paid first. They capture the greatest return.
And at the bottom,
At the wide, massive base of the pyramid is the public market. The mutual funds, the pension plans, your 401k, and the individual retail traders. Money flows relentlessly up the pyramid.
meaning the risk concentrates at the bottom.
Precisely. The people at the top got in cheap and sold high. They bought the yacht. They funded their next venture capital fund. They secured their generational wealth. The person at the bottom, the retail investor buying on day one, is the one left holding the shares that have already peaked and are now absorbing all of the systemic risk. It's a classic mechanism of wealth extraction disguised as a democratic investment opportunity.